Ben, let's just put today aside sort of the risk-on, risk-off fluctuations that we see. Is the pain trade equities higher?
Well, I think we expect a fairly wide trading range from here. We're sitting about overall neutral in terms of risk in our portfolios, but with a bias to be adding. And so what separates today from, let's say, 3 weeks ago is that there's a certain buy-the-dip mentality that has been setting in, and that seems appropriate in what seems like a very wide range that you might expect over the next few months. Obviously, the thing that determines that range is the outlook. So we're getting comfortable with a staggered growth recovery from here, where you get a sharp bounce off a very low level of activity, but not sharp enough to get you back to the pre-shock levels very soon. And the nature of risk around that is essentially that bounce in growth can deposit you and the economy in a very wide array of potential levels by the end of the year. It could be lower than expected easily if reopening is slow, and that's, I think, what we're seeing is a bit of worry around that, just in the high-frequency market moves. But it's also important to recognize that there's upside risk here and clearly some pent-up demand in the system that could get you a slightly more bullish outcome in a year's time.
I thought it was interesting. David Kostin of Goldman Sachs had a note out sort of addressing some similar issues, calling into question the efficacy of the rally that we've seen, saying that investors are dismissing, including $103 billion in expected bank loan losses in the next 4 quarters. You get lack of buybacks, you get dividend cuts, domestic and global political uncertainty. Plus made the point that if you ask any investor, they're all citing like the same 4 reasons for why the equity market is rallying, and that, could be a dangerous signal as well. Where does the downside catalyst come from? What's the downside potential?
Yeah, I think it's really not about the magnitude of losses. I mean, this is a recession, and policymakers are actively leaning against that to try to fill that hole in demand. It's really about the distribution of those losses here, where the incidence is going to fall in part on business owners, but it will also fall in part on the government, in part on the banking system, and in part on landlords and other capital owners. And so I think it's that the catalyst is if those losses are perceived as being uneven in some way, that triggers a more systemic type of weakness. I think that what that all suggests is that you should be a little bit more diversified. Maybe, everyone says that, but even more than usual, in the sense that, if you're adding risk here, equity markets and credit markets are hedged in some sense versus each other in terms of the nature of the shock and the incidence of those losses across the economy. So if you're adding $1 of risk here incrementally, we're sort of splitting it more or less evenly across equity and credit.
Okay, interesting point, and it also sort of begs the question of sort of when we get extra government stimulus. I was interested in Neil Kashkari over the weekend speaking on the morning show, Minneapolis Fed president, about saying, okay, government, you need to step it up again. Here is part of what he had to say.
The worst is yet to come on the job front, unfortunately. And then it really is going to be, as these states start to reopen and as businesses start to reopen, obviously, we need them to reopen safely, and we need to monitor and look for signs of things flaring back up again. We may be in an environment of gradual relaxing and then having to clamp back down again around the country as the virus continues to spread. To solve the economy, we must solve the virus.
Would you put then more stock into sort of reopening successfully or more stimulus from the government?
Are those mutually exclusive? I think there's plenty of dry powder with respect to policy here, both on the fiscal and monetary front. Fiscal measures in the U.S. have been over 10% of GDP already. We'd expect it to get up close to 15% in 2020, all told, and that's additional aid to state and local governments, extending unemployment benefits beyond the end of July, some tweaks to the small business, bailout plans. And on the monetary side, I'd say the Fed is about 2/3 of the way through what it intends to do. You've had the emergency measures, which were relatively successful, the credit facilities, which are just getting online right now, and the third part, which we've yet to even see, is the guidance, the forward guidance that'll essentially pin rates at a low level for some time, and all of those provide an offset to the hole in demand here.
Well, I guess I mentioned they were mutually exclusive because if things go well when we reopen, I could see the deficit hawks getting a lot louder in Congress, which brings me to all the issuance that we're going to get. $96 billion just this week, 3, 10, 30 years. Would you be buying?
Buying what? Buying bonds?
Treasuries on that?
Well, I think that's a very fair point, which is that up until now, the Treasury market has been your insurance policy against downside risks because of the negative correlation with equities. I think it's fair to say that the payout on that insurance policy is not as high as it has been in the past as a result of those issuance trends and as a result of growth picking up and pushing bond yields a little bit higher from here. And so I think treasuries are still a hedge in your portfolio against taking equity and credit risk. They're just not as strong a hedge as they used to be.
Where would be the easiest hedge? Like, do you want to take on duration risk, or do you want the 2-year yielding like 16 basis points?
Yeah, no, I think you want something that has a very similar contour to the risk asset that you're trying to hedge. So if you're thinking about how do I hedge my equity exposure in my portfolio, I think a logical candidate is the dollar. So the dollar we usually think about as being driven by relative growth differences and relative policy differences across countries. All of those are relatively minimal now because growth is in free fall everywhere and starting to trough, and policy is easy everywhere. And so what's driving the dollar is just risk sentiment. It's the same underlying factor as is driving equities. And so if you're looking for a hedge for your equities, it's probably the dollar and other currency risk.